Hello and welcome to Smartkarma's corporate webinar. I'm Sanam Nanwani from Smartkarma. This week we are hosting AIMS APAC REIT. We are glad to have with us CEO Russell Ng. We will start the webinar with Russell walking us through a company presentation, after which he will engage in a fireside chat with Smartkarma Insight Provider Angus Mackintosh. We are taking live Q&A. So I would like to request our attendees to post your questions in the Q&A tab at the bottom of your screen. During the webinar, we will also share some links on how you can connect with AA REIT and read more research by Angus. So please do keep a lookout for messages in the chat box. I now hand it over to Russell to walk us through a short company presentation. Russell, please.
Great, thank you very much, Sanam. Look, I'll start the presentation and really cover three areas. Just a quick overview of our business, and I'll touch upon our last quarterly financial results and portfolio metrics. And I'll just cap it off with our sort of key investment merits, just to summarize the overall presentation before moving to the fire chat. Right. Look, for those of you who may not be familiar with us, AIMS APAC REIT, or as we like to call it, AA REIT in short, is sponsored by AIMS Financial Group, a diversified services company who's headquartered in Sydney, Australia. You know, look, our mandate is really to invest in industrial properties, which comprise of logistics and warehouse buildings, general light industrial properties, business parks, and high-tech properties. And so this really sort of forms the core of our portfolio. We currently invest across Singapore and Australia. We have 26 properties in Singapore and 3 in Australia. In terms of total portfolio value, we're about 2.3 billion in terms of total assets. And in terms of sort of general key stats, we're currently at 98% occupancy, close to 98%. Portfolio WALE, which measures our average lease term, is at 4.5 years. So this metric provides a good gauge for the REIT's income. And we also have close to 200 tenancies, which provides the REIT with a good sort of income diversity. Now, I guess the story of AA REIT sort of really originated in 2009. This is when AIMS Financial Group, as sponsor, sort of took over the then distressed Bakato Cook Industrial REIT. At the time, the REIT, as you can see, the market cap was about 60 million. And today, the market cap today is close to about 950 million. And as you can see on the left side, our current sort of asset size when we started was about $500 million. And today we've sort of grown 4.5 times to 2.3 billion. So really sort of grown significantly. And much of that growth really sort of came through the 13 projects that you see on the right side. Now, these 13 projects comprise of 6 development projects, 4 major asset enhancement projects as well, and 4 targeted acquisitions. Together, the 13 projects, these 13 projects are valued at about 1.6 billion, which accounts for about 70% of our portfolio by value. Now, in essence, we like to sort of focus on this point because the heart of the portfolio really comes from these 13 properties, which have either been redeveloped to very sort of modern specs, or enhanced, or were acquired with really sort of high quality building specifications as well. And so as a whole, this allows the portfolio to really be resilient and defensive across all market cycles. And as a result, these individual assets continue to be high demand by sort of leading corporates. So over the past decade, we have been probably one of the more active REITs in terms of redevelopment. We have developed and enhanced close to about 2.8 million square feet of new space. Now, of these 6 projects, 4 of these projects were ramp-up facilities. And ramp-up facilities really allow each floor to be treated as individual ground floors and therefore command higher rents and also be higher in demand. The 2 balance developments were purpose-built projects for our advanced manufacturing and distribution customers. Today, we've got another 500,000 square feet of untapped plot ratio. And I think recently we acquired the Woolworths headquarters site in Australia. Over the long term, we also have the ability to unlock close to about 1.5 million of additional new space in that market. On the acquisition front, as I mentioned, we've been fairly disciplined and targeted, really over the past decade. And these 4 acquisitions have really sort of solidified the foundation of our portfolio. When we look at assets, we look at everything from, your asset quality, length of lease, credit covenants of our tenants, as well as the location. Is it near, key infrastructures? Is there critical mass or an ecosystem of other businesses in that location? Now, we acquired our first property, Optus Centre. We acquired a 49% share in 2014. Since that time to today, the property value has almost doubled from about $370 million to close to $750 million today. And in 2019 to 2021, we were fairly active and were involved in 3 acquisitions, an industrial warehouse showroom in Queensland, Australia. This is leased to Board Riders. Board Riders is really the parent company for Roxy, Quicksilver, and other surf and streetwear. KWE at 7 Bullen. This was a property that is located in the Geelong Innovation District, and really sort of serving quite a number of high-value industries in the pharmaceutical and life science space. And lastly, we did acquire a very high-quality business park in Norwest Business Park in Australia, and this is leased to Woolworths for a 10-year lease period. In addition to our sort of redevelopment capabilities and investment capabilities, we also included a list of projects to really sort of highlight our leasing and marketing capabilities. Our team has had a very good track record in leasing and negotiating long-term leases to sort of global and national corporates. Optus Centre, we negotiated a 12-year lease with Optus in 2019. That was following our acquisition of that asset back in 2014. So that whole process of negotiating that lease resulted in a significant valuation uplift. And that whole process involved, really engaging the tenant 2 or 3 years earlier prior to the actual maturity, and working through a CapEx-led program to really improve the overall property and amenities. 3 Tuas Avenue 2. This was a property which we had, again, redeveloped. It was a 40-year-old warehouse, and we knocked it down and sort of built it into a ramp-up 4-story facility. And when we built it, we didn't have the tenant in place. We were sort of developing that asset with the mindset of potentially leasing to multiple tenants on different floors, but having the ability to lease to a single tenant. And just prior to completion, ResMed, which is a global medical device company listed on the New York Stock Exchange, negotiated and wanted to take over the entire site. So that was really a great outcome for us. That property value, increased from about 20 million to about 50 million today. And lastly, in FY22, we'd also like to showcase this property, North Tech, which is located in Woodlands, up north of Singapore. This is a property which we've had in our portfolio for many years. The tenant Illumina is a leading global life science tenant. They really sort of manufacture medical equipment that tests DNA genomes, and we're also involved with the analysis of the COVID-19 pandemic and sort of working through the virus DNA process. So they've grown in the building with us. They started at about 10 to 12%. They're now at about 99% of the property. And so, they've grown in the building because the building has been upgraded to, again, an A-grade standard today. And that's really been the proven capability of not only the leasing and asset management team, but our construction and development management team as well. Now, as a result, our occupancy at the portfolio has been consistently higher than the JTC national average. We've trended from about 93% to close to 98% today. And that's really due to really the quality of the assets and the proactive nature of our asset managers to engage and retain our tenants over the long term. Now, this slide just gives a good reference in terms of the portfolio construct. Logistics and warehouse make up about 43% of the portfolio. And again, these are typically shorter lease assets because the underlying contracts with a lot of our third-party logistics customers are usually 2 or 3 years. Business parks, again, this is predominantly our Woolworths headquarters in Australia and Optus headquarters in Australia as well, both of which are on 9 and 11 years balanced lease terms. And high tech, which is about 6.9%, is again a property Illumina at Northtec, and that is again a long-term lease. So when you just combine the logistics and warehouse with the business park and high tech, that makes up close to 80% of our portfolio by income. So you've got the high tech and business park assets, which provide you with very stable long-term income with growing escalations every year, and the logistics and warehouse space, which allows us to sort of play and sort of capitalize on positive rent reversions, helping us to drive revenue and DPU growth. On the right side is really a blend of our multi-tenancies and our single users. About 80% of our single users have inbuilt escalations every year. The majority of our multi-tenancy properties are mostly our logistics and warehouse properties, which have shorter WALE and provide us for really sort of stronger rental growth, particularly in markets like today. And again, I like this slide because it really sort of demonstrates the quality of the tenants in the portfolio. We have over 50% of our revenue really derived from leading global, regional, and local companies. Just our top 3 tenants alone have sort of balanced lease terms of between 7 to 10 years. Our 4th largest customer, KWE, has got a balanced lease term of about 1 year. However, we are in advanced negotiations with that tenant for a further renewal. Again, hopefully sort of adding to that track record of renewing leases with our large customers. On the right, if you look across the pie chart, across the various industries, we have about 80%, I would say, in defensive and resilient trades. Customers, still have to spend and be involved in the logistics trades, food staples, data centers, and telecommunications, healthcare, and life sciences. So whether there's a COVID pandemic or whether there's a potential recession on the horizon, we view these trades as very resilient and very stable. And I think, as I mentioned earlier, Australia represents about 38% of our portfolio, Singapore 62%. Now, all our Australian properties are freehold in nature, whereas the bulk of our Singapore properties are all leasehold. That's just the nature of that market. So on an average, weighted average blended basis, the portfolio has about 55 years balanced lease term, which we think is one of the highest amongst our industrial peers. Great. And so I think for this section, I'll just touch upon quickly, our last sort of third quarter financial results. Really, the third quarter and 9 months year-to-date results were mainly driven from higher rental growth across our Singapore and Australian properties. And really, the bulk of that growth came from our embedded rent escalations, which typically range from 2 to 3% across our master leases, as well as very strong rent reversions from our multi-tenanted properties within the logistics, warehouse, and industrial space, as well as the full period contribution from our Woolworths headquarters acquisition, which we completed in November 2021. Looking below our balance sheet, and it's been fairly stable quarter on quarter. Gearing remained at about 36%. And so I think that's been a sort of stable sort of performance for us. NAV was about $1.38. It's dropped slightly from $1.40, and that's mainly due to FX translation movements for our Australian properties. And based on this set of financials, we're currently trading about 4% discount to NAV. I think that's trended up as of today, and our distribution yield is about 7.8%. That was based on a unit price of $1.33, and I think that's tightened slightly based on a higher unit price as of today. So coming back to gearing, again at 36%, that's fairly fairly comfortable at this level. Typically our gearing will trend between 30 to 40% within that range. Funding costs has rose slightly on a quarter-on-quarter basis. It's gone from 3% to 3.2%. but again, largely comfortable, given our interest rate, interest cover of 4.6 times. Even though it's dropped to 4.1 times, it's still quite, materially higher than our banking covenants. So no concern there. And again, really comfortable at our current sort of gearing levels. 88% of our total debt is currently fixed. Now, I guess looking at the lower left debt maturity profile chart, as you can see, we don't have any sort of debt expiring for our current financial year up to March 2023. We have a small tranche in FY24, 29 million. But overall, across our sort of capital management strategy, borrowings are hedged at 88%. And I think income distribution from Australia, we have about 70% of our distributions hedged using forward currency contracts. And this is effectively sort of managed so that there's a rolling 12-month rolling hedge on our distribution to ensure that really protects the overall DPU for the portfolio. Over the last quarter, our team has been, very active. We signed 27 leases, representing about 7% of the portfolio. Now we achieved, probably a record sort of rental reversion for that period of about 21%. Again, mostly driven from our logistics and warehouse segment, as you can see, 25.9% for that period. And that's really been a strong performer and a consistent theme, not only in the past 3 quarters, but also in the preceding year, during the COVID-19 pandemic. It's been a strong and resilient segment. For the rest of FY23, as you can see, the bulk of our expiries are in that logistics and warehouse space. And the same for FY24, we've got close to 80 to 90% expiring from the warehouse segment. Now, ESG really has been a key focus for the industry and particularly for us. We are in the midst of finalizing our ESG sort of framework and working on a new sort of carbon footprint reduction framework over the next 10 years. Now, this will really sort of involve several energy conservation projects. We've got a major rooftop solar system that is currently being installed across 6 properties with SP Group. That's enough power to really sort of generate and power 4,000 HDB flats. So it's quite a substantial project. And really on the social front, we're focusing and spending a lot more time with organizations such as Habitat for Humanity and Food Bank to really sort of help the underprivileged in our communities. So really that's going to be a key focus for us, and hoping to build up on this particular framework across the environmental, social and governance aspects. And really just to summarize and recap, what I see as our key investment merits. I think firstly, we have curated a portfolio of very high quality assets. A big bulk of our assets were either redeveloped by the manager, enhanced, or acquired. Assets that were acquired were of really high standards. So that's really sort of underpinned the performance and the portfolio metrics. We have a very strong and diversified tenancy base. As you saw earlier, our top 10 tenancies were all sort of, leading names in their respective industries. 80% of our revenues are coming from, these defensive and resilient industries, which, again, will allow us to perform in various market cycles. We have a very active asset and lease management strategy. Really, that's our bread and butter. The underlying leasing of the assets really sort of drive the performance from an occupancy perspective, retention perspective, as well as rental reversions. We take a very prudent and conservative capital management approach. We sort of look at all refinancing, be it debt, interest rates, hedges, and foreign currency hedges, well ahead of those expiries, and we try to plan these hedges to mitigate any adverse impacts. And I think, just to cap it off, we have a decade-long track record in asset enhancements and redevelopments. And, really created a lot of value, through really driving organic growth, through adding, almost 2.8 million square feet of new space. And I think lastly, we have the proven capabilities to execute and source, great acquisitions that have been DPU accretive. And so this ensures that our portfolio continues to be sort of carefully curated so that we can really sustain this performance over the long term. that concludes the presentation, Angus.
Great, Russell. Well, no, thank you very much indeed for that. It gives, I think, a very clear picture of what AA REIT's all about. I might just start off with a very simplistic question as to what made you list in Singapore in the first place. I mean, obviously there are a lot of REITs listed in Singapore, and obviously investors will gravitate towards it for that reason. What would you say are the main advantages to being there?
Yeah, sure. So look, as I mentioned in the presentation, we AIMS Financial Group sort of took over the old MacArthur Cook REIT back in 2009, 2010. But really the Singapore market REIT market is very well established. It is a global hub. You've got multiple Singapore REITs with investments globally, not only in Australia but also the US and Europe. So it's a very deep and liquid market. There's quite a number of investors who are also based in Singapore and use Singapore as their global or Asia Pacific hub. So that's been highly beneficial. And clearly there's significant trade flows between Singapore and Australia from an economic and as well as social perspective, actually. So that's really benefited the REIT from that perspective.
Very good, and obviously you've given us a sort of broad picture of where the companies come from, where the REITs come from, and obviously there's a very interesting strategy I can see from sort of redevelopment and improving properties and increasing the space along the way. But just to take a step back, I mean, what would you say are the company's sort of key strategies for growth? Given is it through acquiring buildings that can be redeveloped? Is it through acquiring buildings that can be enhanced, or is it a mixture of different sort of target assets?
Sure. Look, that's a great question, particularly in an environment like today where there is rising inflation, rising interest rates. Look, a really core fundamental part of our strategy is really sort of strategic investments. That's really going to get you the sort of larger sort of growth impact in terms of DPU. However, when you're in a market and cycle like this where there's rising interest rates, it's made it much more difficult to sort of underwrite investments that are DPU accretive. So we are looking at acquisitions very much more opportunistically. We continue to review and assess projects both in Australia and Singapore. And to really keep track of where the market's going, because there will come a point where the market shifts, and we are, obviously aware of where pricing is going to be. So acquisitions still remain very much a key part of that growth aspect. But again, we've had the benefit of really having that redevelopment and asset enhancement capability over the past decade. So in the current cycle, really the focus for us is really driving organic growth. As I would like to say, sort of sweating assets, really sort of generating the most that we can from each and individual properties. So having a property portfolio of 26 buildings in Singapore really gives us that ability to look at further upgrades. So we've been sort of balancing upcoming asset enhancements with really sort of the return metric, and so we look at everything from yield on costs, total return, as well as the DPU accretion from these projects. So really acquisitions has been the primary, probably not the most suitable in the current cycle. Asset enhancements, redevelopments are certainly key for us as well. But again, development projects typically have an 18 to 24 month gestation period from design, authorities approval, all the way to construction and completion. So we are underwriting and evaluating a few of these projects, but again, balancing against the where rental levels are, and as well as construction costs, because we have seen elevated costs across materials and labor costs as well, which has affected the overall construction.
Right. And is it a competitive landscape for you in terms of you're looking at assets? Are there likely to be a number of other bidders out there for the assets?
Look, I think in any particular sort of market, there's always competition. Obviously, when markets are a lot more buoyant, you might get a lot more competitors in the market. So look, I don't think that's really sort of disadvantage us in any way. I think it depends on really how one would look at the asset from their perspective, because different funds have different criteria. Some funds may be total return focus, other funds may be DPU focus. And so then the ability to extract value through whether it's increasing value, the valuation through doing some asset enhancement works may work for others. For us, we focus very much on the DPU growth, and also what really so helps on that underwriting is sort of the funding cost aspect, and also really sort of personal relationships. So I think as a business, we do have very good networks in the markets that we operate in. We're able to sort of source and underwrite deals that are on market as well as off market transactions through various networks, whether it's through vendors, bankers, consultants, and the like. So that hasn't sort of affected the ability to find the good deals hasn't been an issue for us. It's just really sort of finding the right timing in the market cycle, I think.
Right. I mean, actually, there is a question which has come in, on the subject of acquisitions, which I'll just put to you. Could you provide more colour on why the acquisition of 315 Alexandra Road failed? And also, could you just comment if interest rates or lack of industrial property sellers is the main impediment to AA REIT's growth?
Sure. So I'll start with the first one. So for 315 Alexandra, look, that was a property which we announced, I think close to 2020 period. So we had completed all of the review of negotiated documents with the vendor. Unfortunately for us, that deal didn't occur. Not so much that it failed, more so the underlying sort of tenancy. Unfortunately didn't meet some I think the authorities' approvals at that point in time. So unfortunately for us, we had waited for that project, but I think the necessary approvals weren't obtained from the regulators. So as a result, the transaction had to be aborted at a later date. And I think the question about sorry, is it interest rates?
Yeah, I mean, it's interest rates and a lack of industrial property sales as an impediment to growth. It doesn't sound like that is an impediment to growth, but it is that maybe you want to comment on that? Sure.
Look, certainly rising rates does make it difficult to sort of underwrite new acquisitions. As I mentioned, we are active in terms of the markets that we operate in. What we haven't seen, however, is really sort of property yields sort of moving in the same direction or in the same sort of level of trajectory compared to interest rates. So we are waiting for that yield adjustment to take place in the market before really sort of looking at that as a real viable opportunity. So at the moment, I think that has been some form of impediment in terms of third-party acquisitions. But as I mentioned, for us, we do have quite a number of assets within the portfolio. We've been actively looking at several asset enhancement opportunities, several redevelopment opportunities. These are projects that we'll like to announce once we sort of get enough traction, but certainly there is enough for us to work on. I would also just probably add, we've had a couple of cases where we've had master leases. We've negotiated master leases within the portfolio. Recently, in the December quarter, we've negotiated with one of our data center tenants. And they've sort of agreed to sort of take a master lease over the property, and that's really sort of increased the overall revenue for that building. And we've had several approaches to 2 or 3 other similar approaches from very large corporates who are looking to take over an existing building, and so that from our perspective involves sort of upgrading that property. And sort of working through a potential long-term master lease with that tenant, and that's going to obviously give us incremental revenue, and also raise the overall valuation of that property. So certainly enough organic growth opportunities for us to really sort of drive growth in this period. Right. Yeah. There was another question along those lines, which may have a little bit more. You might add a little bit more on. It's from an anonymous attendee. How does the increase in borrowing interest rate and increase in energy costs affect DPU going forward? How do you see it affecting DPU going forward, and what are the mitigations? Sure. Maybe, look, I'll start with the energy costs. Look, this was an issue probably 2 years ago when there was a couple of gencos effectively left the market, reducing the supply. and there was a big spike in overall energy costs. Now, at the time, we had negotiated with an energy provider, and through that process of securing that energy source, we're able to sort of pass it through to our underlying tenancies. So there was sort of, we're largely mitigated from that spike in overall energy costs. And so that's been fairly well managed on that particular front. Now, borrowing costs is obviously, it's a market-wide and sort of global impact. It does sort of slow down economic activity generally from corporates, and that obviously trickles down to the economy, down to the individual firms. Now, for us, as I mentioned, we are hedged up to 88% on our interest rates. We do have that portion that is still floating, and we do have some of that interest rate swaps that we enter into that will mature over the next 12 to 18 months. So these are things that we'll obviously need to work through. We're carefully sort of monitoring the debt markets and sort of determining when would be the right time to extend some of these interest rate swaps. But look, that will have an impact on DPU. I don't think any REIT won't be affected. But in terms of our sort of current hedge ratio of 88%, I think we're largely insulated. However, there is still that risk that if rates continue to rise, that will have a larger than expected impact on DPU.
Right. Very good. Well, I think that's answered that question. There's one other up here on the board, which I think we probably should just look at now. How do you see the recent announced changes in property taxes affecting industrial property sector and AA REIT strategy in Singapore?
Yes, look, I think the increase in property tax, again, it's industry wide. I think most players will just include that and absorb that in their underwriting, which will ultimately affect the overall sort of returns. So this in itself will be normalized through the process of underwriting and ultimately will be captured in pricing in terms of real estate valuations. So I think in the near term, I don't think it's going to have any sort of material impact at this stage, only because borrowing costs, I would say is probably the larger impediment for transactions to be done. Generally, so I think over the mid to long term, I think the rise in taxes, will have an impact, but it will be absorbed and be adjusted in the overall pricing of the industrial market. But I don't think it's going to be it's going to materially adversely impact the number of transactions that will be completed because it's industry wide. Right.
I mean, you obviously touched on before we started on the questions. We sort of you touched on multi-tenanted and single-tenanted properties, and obviously it seems to me like the multi-tenanted properties tend to be shorter leases, and obviously they can roll over and you get a better rental reversion cycle on those. Whereas the single tenancy are much longer term and they have built-in. So what's the ideal mix between the two? Because obviously one is more stable than the other. But how do you look at that?
And look, I guess the question could be asked, in markets like today where you've got rising inflation, as we know, rents are inflation hedge. You probably want to have more multi-tenancy, shorter wells to really sort of have that that rental reversion growth that we're currently seeing. So I would say our current portfolio now is about 55% multi-tenancies. Look, we like that mix. I think that's, we've always had it between 50 to 50-50 between the multi-tenancies and the master leases. So it's always been around that range. And some periods it may drop to 45-55 on either side. But overall, we like to have the balanced mix, because when the market turns again and there's potentially sort of drop in rental rates, you're glad that you have those fixed 9-10-year leases with a 3% rental escalation. So I would say sort of keeping around this level, 50-50, it's generally ideal for us. It allows us to sort of benefit from really sort of the positive movements in the logistics and warehouse segments at the current moment.
Yeah, and you also touched upon different industries and obviously selecting your tenants is probably pretty important. Could you give us a little bit more color on that? You talked about health tech, talked about tech. It'd be great to get a bit more of a feel for. And obviously you got some very big single tenants like Woolworths in Australia. I mean, how do you look at that sort of by industry, or do you just keep a? I mean, you've got quite a diversified portfolio anyway, but a bit more of a feel for that would be great.
Sure. Look, I think if you look across our Australian properties, Woolworths and Optus are obviously two leaders in their markets. Optus is I think one of three telcos, and Woolworths is essentially one of two major supermarket chains. So that really sort of gives us that stability. I guess if you look across our Singapore portfolio, we've got quite a number of different tenancies, and in addition to the ones I've mentioned, life science and healthcare. Now, we really like these sectors because the customers that we work with invest a lot of capital into their production facilities, and these facilities themselves are also subject to audit and review and approval by the US FDA, Foreign Drug Administration, and as well as the Singapore authorities. And as a result, through that long sort of investment, I think it bodes well in terms of a potential long-term occupation by these customers. So we sort of really see them as long-term partners rather than tenants of ours. So these are really sort of sectors that we'd like to sort of grow into at some point. Another sort of key sort of industry, precision engineering and advanced manufacturing. That's really sort of moving towards where Singapore is heading in terms of Singapore 4.0. Automation, robotics, EVs. We have a tenant of ours who manufactures massive sort of engine casings for Rolls-Royce and airplanes. So again, a lot of capital invested, long-term sort of occupation, in terms of the actual demand space. And so these type of users, when they look at different premises, they are looking for the newer modern facilities, right? Because they're spending 30, 40, $50 million of investments in that property. So these are the type of profile tenants that we like, obviously, to work with, and really it's our role as managers to really rejuvenate our assets so that they become really high in demand from these international and local corporates.
Very interesting. I think you mentioned data centers as well. I mean, that's quite a specialist area, isn't it? I mean, obviously it's a high growth area, and Singapore can be seen, I guess, as a data center hub. Although some countries require you to have it in their own territory. But is that an interesting area, or is that quite marginal?
Yeah, look, we do have one data center tenant in the portfolio, Rack Central. And so, look, we would like to have more. And so we have been exploring and talking with other sort of data center operators for possible conversions. But I think Singapore at the moment has a moratorium. And so they are restricting the number of data centers, really just to manage the overall energy capacity, because data centers, as you know, are energy hungry.
Yeah.
And unless these data centers can be more energy efficient, I think that's really where the government's sort of moving towards, particularly for new data center projects.
Right, and sort of looking at the sort of some examples of properties where you've seen redevelopment potential, and it's really it's sort of surpassed expectations. I mean, that in itself is almost a different, is a different job in a way. The whole redevelopment and improving, existing building enhancement of assets and so on. I mean, what are the risks with that? I mean, what are the kind of? I mean, obviously there can be delays. It's not necessarily always that predictable, is it?
Look, that's right. Look, undertaking developments obviously include everything from sort of planning risk, construction risk. You potentially have no income during a certain period. So from that perspective, we only work with construction partners who have long track records, and obviously having done a few of these projects, we know who the market leading players are. So that's really important. Working with credible, reputable partners with good track records in that particular space. And look, for us, from a design perspective, having done a number of these projects, we typically like to design projects that have the ability to lease to multiple tenants. So we're always thinking about versatility and flexibility in the designs. And so even if we have a single user building, great. But if they were to ever move out in the future, we can easily subdivide the properties to incoming users.
Yeah.
And so for us as a business, we do have, several properties that have untapped plot ratio. And so what we try and do is marry up the expiry of those tenancies and think through a redevelopment scheme. And so we're always looking at the sort of risk-adjusted return and yield on costs by undertaking these projects at different times of the cycle. So,
right.
Yeah. So there are risks involved, but typically higher rewards in terms of higher revenue.
Higher rewards, yeah, and I guess it's a very measured risk because you have the basic asset there. It's just a question of how you enhance it and redevelop. And do you consider sort of greenfield projects, or are you more sort of focused on redeveloping existing buildings?
Look, that's a great question. So we have in the past 10 years undertaken a greenfield project. One of our projects called Bionics. We did acquire the land from a third party, and we did find and source a tenant. And they are also in the advanced precision engineering industry, where they build sort of specialized parts for healthcare, EV products, pharmaceutical technology. So I think that was an example of one greenfield project. So I would say it's certainly something that we would explore, but again, it really depends on the market in terms of availability of land, because a lot of the land in Singapore is actually governed by JTC. So you do have an added layer of complexity in terms of negotiating not only with the landowner, which may which may be a third party, but then JTC as well.
Right.
From that perspective.
Yes, you mentioned during the initial sort of presentation that you obviously have a portion of buildings which are predominantly freehold in Australia, and Singapore is predominantly leasehold, if not all leasehold, is it?
In Singapore. Look, Singapore, the industrial market, I would say, the large majority is leasehold. There is a small handful of freehold industrial properties. But these are not typically institutionally traded. It's mostly sort of held by privates.
So there's not really any advantage or disadvantage. I mean, I guess the cost of buying freehold is much higher than buying leasehold properties. So it's just managing that, in fact, tying up capital that you don't necessarily need to.
Look, exactly. So typically when you buy freehold industrial properties, the yields are about half that of leasehold industrial properties. So doesn't make it attractive for institutional buyers.
Yeah.
But that being said, leasehold properties in Singapore, even though it's governed by JTC, there is an ability to extend the land lease, but it's going to be on a case by case, depending on multitude of factors, such as the underlying sort of tenant usage, the master plan, for that location. So it doesn't necessarily mean that leasehold means that the property falls to zero. There are cases where properties have been extended, but it is really a case by case.
Right. So extensions, do happen, but it's the general. I mean, what would be the average sort of leasehold term in Singapore, just to give a bit of a color on that?
Look, on average, could be anywhere from 20 to 40 years.
Right.
That's probably the range. That's probably the range.
No, so it's a pretty decent length of lease. There is another question that's come in from an anonymous attendee on data center. AA is looking to provide the superstructure or shell building only for data centers, or do you also include the fit out, which can be quite capital intensive? I know you said you only had one, but effectively, are you just providing the building, or are you providing the infrastructure around it and the air conditioning and whatever else?
Yeah, look, that's a great question. I think there are different models when it comes to working with data centers. Our current data center at the moment, we just provide the shell and core. They sort of spend their own sort of capital on the fit outs for their own purpose, and that's typically the REIT model. We try not to get too involved with the actual fit outs, which are typically quite specific and quite tailored for these operators. So if we were to work on any new data center projects, that would be the typical model, providing the shell and core and working with the operator in terms of having them do the fit outs, and we sort of provide the overall structure of the asset.
Yeah. Very good. And I just did sort of pick on something when I was looking through. I mean, obviously you have a very high occupancy rate, 97%, but the tenant retention rate is 79%. I mean, I guess that's just because you have rolling tenants going in and out of shorter term sort of logistics buildings. Is that right?
Look, that's right. That's right. So I think our retention rate, which we calculate on a 12-month rolling basis, it's ranged between that 75 to 85% sort of rate. Now, I think as a sort of general rule, we work with our existing tenants, or customers, and essentially look to sort of renew these leases. However, as you saw in the rental reversion figures, I think that the last quarter was about over 20%. So we do have to try and balance between working with existing tenants on renewals versus new prospects, and we try to. There's a happy balance. We typically try to work with existings, but also, they have to sort of come up closer to market. They might be slightly lower discount to the market rate. So that's how we typically try to approach it. In the current sort of environment, I don't think that's a lower retention rate is a negative. In fact, it's probably a positive.
Yeah, it's a positive. Yeah, because you got more opportunity effectively to enjoy the inflationary environment in a sense. I guess yeah, it's quite a bit of a privilege to be able to enjoy an inflationary environment. So that's interesting. So the reversion cycle. I mean, obviously, it's been very, very strong. In last year, first 9 months. I mean, that's a very strong number. I mean, is that sort of growth rate sustainable? I mean, what's the sort of long-term sustainable sort of rental reversion cycle? I mean, you talk about obviously on the fixed long-term single tenant projects, it's kind of 3% a year. But in this environment, how do you think? Can we still be in double digits?
Sure.
I don't know how much you can say on that.
Look, I think we're kind of monitoring the sort of JTC supply. So JTC is obviously one of the largest sort of landowners, and seeing how that supply is being projected over the next couple of years. Anecdotally, construction stopped really sort of during COVID. It started to pick up again, and so your typical sort of gestation period is about 18 to 24 months. Mm-hmm. So I think we're still in a situation where there is fairly tight supply, I would think, over the next 12 months. And I don't think it's unique to the industrial market. It's really sort of happening across the board from residential, commercial properties as well. And so looking across our portfolio and just looking at where the sort of passing rents are and where the market rents are, I think we've still got a good sort of 6 to 12 months potential, position for strong reversions over double digits. So I think that's my sort of personal view, but I think it really depends on how quickly I see new projects start in this environment. Yeah.
Yeah, well, we've probably got time for one more question, and then we're out of time, Russ. Unfortunately, there's a lot more to talk about. So, question from anonymous attendee: what are the 3 major challenges for AA REIT in 2023 or even 2024?
Look, I think that clearly the first one is interest rates, because I think that really sort of impacts not only underlying sort of impact on DPU. It impacts acquisitions. It impacts potential, slows down economic activity, which may slow down demand from our tenants. So that's really sort of the main risk that we see. And we're also sort of just sort of coming from that particular risk. Whether the global slowdown and the US recession that typically has an impact on Singapore. Singapore is it's an economy that's affected from various parts of the region. And whether that will be sort of counterbalanced with the reopening of the China borders, or whether that will spur some sort of good demand in that particular market. So I would say that's probably the biggest risk. I would say that the number 2 would be, really sort of a slowdown from tenancy demand, whether they gain a flow on from rates and economic slowdown. We have seen Singapore GDP slow down slightly over the past few quarters. PMI manufacturing data has also slowed, so that hasn't sort of impacted in terms of the actual demand from our leasing and tenant prospects, but we're closely monitoring that. And I would say probably the last one is it's essentially funding growth for funding for future growth, because it's raising capital in this market is not cheap, in whether it's debt or equity. And so that's probably the third risk I would say, that's sort of impending, potentially affecting growth.
Right. Well, Russell, thank you very much. That's been a very interesting discussion, and obviously we could have gone on for a lot longer, but at this stage we're going to sort of draw a close to the discussion and fireside chat, and I'm going to hand you back over to Sanam. Thanks again.
Great. Thanks, Angus.
Thank you.
Thank you, Angus, for some very interesting questions, and a big thanks to Russell for a detailed insight into AIMS APAC REIT, the challenges in the real estate sector, and opportunity for AIMS APAC REIT. I would also like to thank our attendees who joined the session live. With that, I would like to wrap up this week's corporate webinar. Thanks again and have a great week ahead. Thank you.